Welcome to Pro News Flash. The S&P 500 has returned to pre-war levels. Let's dive into the latest developments. The US stock market has returned to pre-war levels, turning a blind eye to the Fed's interest rate hike, the oil crisis, and the threat of stagflation. Brent is trading $30 a barrel above levels before the Middle East conflict. Treasury bond yields are 35 to 40 basis points higher, and traders have all but given up hope that the Fed will cut rates in 2026. Conditions are far worse than at the end of February, yet the S&P 500 is at the same levels. Expectations of strong corporate earnings, a robust economy, and peace in the Middle East underpin the rally in the broad stock index. Despite the continuing uncertainty in the region, investors are buying into rumors of an agreement between the US and Iran. Markets are tired of geopolitics and are switching to fundamentals. According to Wall Street analysts' forecasts, earnings per share for S&P 500 companies will rise by 12.5% in Q1, the sixth consecutive quarter of double-digit growth. Meanwhile, the number of companies issuing upbeat corporate earnings forecasts is set to reach its highest since 2021. Strong financial performance is impossible without a robust economy. The Wall Street Journal noted that experts just slightly lowered their forecast for US GDP growth this year and have barely raised their estimates of the risk of a recession over the next 12 months. Over the past 6 years, the economy has grown by an average of 2.1%, which aligns with expectations of 2.0% for this year. This is thanks to artificial intelligence and rising productivity. Although Fed rates are high by historical standards, the real yield on US Treasury bonds, against a backdrop of accelerating inflation, does not suggest that monetary policy is too tight. The S&P 500 correction in March lowered companies' fundamental valuations. This includes the price-to-forward earnings ratio. Shares now appear undervalued and attractive, which is stimulating buying. Stay tuned to Pro News for further updates on developments in the financial markets. Like, share, and subscribe.